Good day, and thanks for joining us for our Corn and Soybean Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today is my colleague, Dr. Michael Langemeier, who's a professor of ag economics and also the Associate Director of the Center for Commercial Agriculture. We got some surprises from USDA on Friday. They released both the grain stocks report as well as the planting intentions report, and it was a bit of a surprise in a number of respects. The corn stocks were larger than expected. The March 1 estimate came in at 8.6 billion bushels. That was about 270 million bushels larger than the average pre-release estimate in the trade that was circulating before the report. On the corn planting intention side, we have more corn acres than expected. It came in at 92.792 million acres. That's up not quite 1.5 million acres above the pre-release estimate that was circulating really the last couple of weeks. And on the soybean planting intention side, those acreage estimates were smaller than expected at about 84.617 million acres. That again was about 1.5 million acres below the average pre-release estimate. So a bit of a shock, at least on the corn stock side and a little bit on the acreage side, Michael. And really causes us to maybe shift the outlook a little bit, maybe not quite as much as the futures market reacted on Friday in terms of our longer term perspective, but nevertheless kind of changes things a little bit.
Yes, it certainly changes the potential corn to soybean price ratio.
Yeah, and I think one of the issues is how much change might we see over the next few weeks as both weather conditions change and people react maybe to some changing price ratios. Let's take a look at some of the things that were going on behind the scenes that maybe drove the changes that we saw in the USDA numbers. And if you think about that corn stocks number, maybe there were some clues that we should have been paying a little closer attention to prior to the report that might have given us some indication. This chart takes a look at weekly ethanol production as a percent of the prior year, and really is a response to some pretty negative margins in the ethanol sector. And it's been pushing those ethanol production numbers down. That was probably one of the big components with respect to pushing that corn stocks estimate up above estimates prior coming into the report. And then as you look at the export side, exports have been lagging a bit as well. Corn export commitments so far down about 8%. USDA's only got them down 3% in their balance sheet, the one that they released earlier in March. Our expectation is that we could see that come down when USDA releases their updated world ag supply demand estimates here on, I think, the 9th of April. So look for a little bit of a reduction there. Those are the two probably drivers on the consumption side with respect to what was taking place on that corn stocks estimate. The other one is the possibility that USDA actually underestimated yields a little bit last fall. And I know that's a surprising thing to say given how high yields were, but as you look at these consumption numbers, that probably is the driver there with respect to what was taking place. Don't you think, Michael?
Yes, I think that's probably a likely scenario that the yields were higher than the actual numbers and increasing those stocks.
And you know, I think there's been some discussion about feed usage and USDA underestimating feed usage. The bottom line is USDA doesn't have a direct measure of feed usage. It's a residual category, so it really probably falls down to what was taking place with respect to exports, ethanol production, and the estimate of yield coming out of the 2018 crop, which I suspect was a little bit underestimated, particularly given what was taking place with the late harvest last fall. So on the acreage side, that was pretty interesting. Looking at the acreage, corn acreage in the U.S. up about 4% compared to a year ago. But the state breakouts are kind of interesting, Michael. You might want to comment on those.
Yes, the expected corn acreage is up about 3.6 million acres from last year, and a full 45% of that increase is from North Dakota and South Dakota. So some anticipations of some very large increases in corn acreage in North Dakota and South Dakota. But as you can see from this chart, most of the states are up. It's just that North Dakota, South Dakota was through the roof.
Through the roof, indeed, and I think that's going to be interesting as we play out the scenario here for the month of April and maybe into early May with respect to weather conditions. A lot of discussion about the impact of not only wet weather and flooding, but also cold weather in that part of the country, and whether or not we'll actually see those planting intentions realized. Let's take a look at the soybean planting intentions change as well. No big surprise there, although in light of the previous chart, but again, a pretty big shift going on with respect to the upper Midwest, Minnesota, North Dakota, South Dakota, and even Iowa, down pretty sharply.
Yeah, if you look at Iowa, Minnesota, North Dakota, and South Dakota, that's about 40% of the reduction in soybean acres just in those 4 states. And so even though it shows only 6% in Iowa, that's a lot of acreage. 6% in Iowa is a lot of acreage, and so those are some pretty big numbers in terms of reduced soybean acreage in Iowa. The same is true for Minnesota, very large soybean state, and in North Dakota, South Dakota, that's consistent with the previous chart, looking at the large increases in corn acreage.
And then as you look at the eastern corn belt, I think consistent with some of the work that you've been doing for the last couple of years, the returns to soybeans tend to look better in the eastern corn belt, and I think the acreage shifts reflect that.
Yes, definitely. I mean, this year corn, as we're going to show a little later in the webinar, corn is more competitive compared to soybeans, and so it was not real surprising that the soybean acreage declined, expected to decline in Indiana. But I do think it's important to point out that even with this negative 4% soybean acreage change in Indiana, we're still expecting more soybean acres than corn acres in Indiana and Ohio.
And it is interesting, though, that as you move farther east in the Corn Belt, soybeans historically have looked more competitive than corn, and this chart reflects that, with Ohio only down 1%.
And our friends in Illinois have done some budgets recently looking at relative corn and soybean profitability, and it's not real surprising to me that soybean acreage is only down negative 3% given some of that analysis. Soybeans are still very competitive in both Indiana and in Illinois, and that's reflective of this relatively small changes compared to some other parts of the country.
All right. Let's take a look at the balance sheet for corn, and this really reflects some analysis done by our colleague Chris Hurd in the Department of Ag Economics. Chris is not in the set with us today, but he did provide some of this analysis, and we really appreciate that. So let's take a look at the balance sheet. We've got the balance sheet for 17-18, just from a kind of a historical perspective. The current USDA balance sheet, the one they released earlier in March, and then Chris's projections for what he's expecting to see when USDA releases the updated WASDE estimates here in early April. And as you look at the change that took place with the ending stocks, with the stocks report on Friday, and reflecting that what's really taken place, Chris's expectation is we're going to see a reduction in feed usage show up on that next report. A reduction in ethanol usage consistent with that chart we just showed, a reduction in exports, again consistent with the fact that exports have been running below USDA's estimates, and the bottom line, probably see a reduction in total usage of about 150 million bushels. Now keep in mind the grain stocks report was up 270. We're only looking at a change in total usage of about 150. But that still pushes that ending stocks number up really close to that 2 billion bushel mark, puts us at just below that at 1985, and gives us a U.S. farm price for this year of about $3.50. But I guess I have to caution that it's hard to move the U.S. average farm price very much at this stage of the marketing season because roughly 70% or so of the corn has already been marketed. So you're looking at on the remaining corn, probably a little larger change in price than what that nickel would suggest on the chart. And then maybe the more interesting thing is to think about what the 1920 balance sheet starts to look like. So here's a projection for the 1920, again, based on Friday's report with respect to acreage, using the planted acreage, planting intentions report data, adjusted for harvested acreage. Using the USDA yield estimate that they put out in late February at the Ag Outlook Forum in Washington, D.C., and then just kind of walking through the consumption. And as you look at it, I think there's a couple of things that kind of jump out to me on that chart, Michael. The first one is projected production, corn production, right around 15 billion bushels. Usage, about the same, so maybe even just a touch larger than production. So that's impressive in light of what's been taking place in ag, that we could actually have usage that large. And then an ending stocks number still hovering around that 2 billion bushel mark. So I think coming in, there maybe was an expectation that we could pull down ending stocks a little bit in 2019. The report on Friday maybe suggests the combination of larger carry-in with respect to those ending stocks coming out of the 18 crop and the larger acreage on corn is going to make it tough to pull down ending stocks without some weather problems.
And as we note on the chart here, feed and residual is expected to be higher. If that doesn't materialize, that would increase stocks. And also exports are expected to be more similar to what they were in 17-18, versus what they were in 18-19. So any change in those two numbers, and you'd actually see ending stocks higher than what we're showing here, obviously.
Yeah, and so with an ending stock number of around 2 billion bushels, that's probably going to leave us pretty close to that $3.50 mark for our U.S. farm average price. And again, I think coming in there was a little bit of an expectation, or a little bit of a hope anyway, that we would see a modest improvement there.
I think coming in, we thought there might be more upside to corn than what we're illustrating here in this balance sheet.
That's a good way to put it. Let's switch gears a little bit and start thinking about soybeans just a bit. Here's a chart that maybe would give us some idea as to what's taking place in the soybean market. It's one we get a lot of questions on, and it's the change in soybean sales to major destinations. And of course, the one we've been worried about, the one we've been talking about so much, is China. Those sales down 636 million bushels, a 60% reduction compared to the prior marketing year. We have picked up sales elsewhere in the world, that's the good news. But we have not picked up near enough to offset the decline that's taken place with respect to China. So rest of the world exports up 317 million bushels. Bottom line is, on a net basis, we're down about 319 million bushels, or about 19% compared to a year ago. So that's really the bad news, I guess, on the export side. If we look at that a little more broadly, current export sales, as I just said, running about 19% behind last year. USDA's most recent balance sheet had it only down about 14%. They'll probably wind up revising that export projection down on the balance sheets that they release here next week. But a tremendous amount of uncertainty about what's going on with China. Another round of negotiations taking place this week. We're all cautiously optimistic that something will be resolved that would be favorable to U.S. agriculture, but we don't know, right? That's the wild card in the export picture, isn't it? Let's take a look at the balance sheet itself. Again, like last time, I've got the history for 17-18 on there. The USDA's current balance sheet that they released earlier in March. Chris Hurt's kind of projection, or revised projections, based on the reports that came out Friday in terms of what might be taking place there. Bottom line, coming in, USDA projecting ending stocks of about 900 million bushels. Even with the revisions from Friday, probably not much change there. And that leaves that farm price, that average U.S. average farm price, probably unchanged at about $8.60. As you look at that first pass for the 2020 balance sheet, bringing in those 900 million bushels as ending stocks, and it's hard to say, Michael, to actually say it. We're carrying in 900 million bushels, but that's what it looks like unless something really shakes loose on the export side. Production down from last year based on that acreage report on Friday, looking at the 84.6 million acres, and then an average yield of just below 50 bushels per acre on a U.S. average basis. Gives us total supplies a little over 5 billion. As you look at the other numbers on there, probably the wild card is going to be the export number. The export number Chris is carrying is up just over 2 billion bushels, but a lot of uncertainty around that number with respect to what's taken place, especially with China. If we do get the 2 billion bushels, that'd give us an ending stock number that's smaller than this year, down from 900 or so down to about 780, 790, which would push up that annual average price to maybe $8.80. And Michael, I think your point earlier was, if we think about that in Indiana, that suggests the opportunity to see an average cash price maybe, what, over $9?
Over $9, at least slightly over $9. One thing that's interesting about this, the 1920 balance sheet, is even though Chris is showing an increase in exports here, we're still not at that magic 50% of the crop. 50% of the crop being exported like we were back in 17-18. And so it looks like we might get some of the exports back in terms of his projection, but certainly not all of them.
Yeah, and I think that really underneath that is an expectation that we would see some of those other markets pick up, and they did pick up substantially over the last 8 or 9 months, but it's taken a while to redirect that and really change the trade flows in soybeans around the world. So it's going to be interesting to see how that shakes out, but obviously a tremendous amount of uncertainty about the whole China situation continues. And we're all optimistic that that would be resolved, but who knows. All right, let's take a look at the futures prices. This is corn futures, and it's the May futures, so that the nearby old crop. And as you look at it, on Friday, the markets reacted pretty negatively to the information on the reports. Our view is that that probably was a little bit of an overreaction with that hard drop on Friday. We'll see how that plays out this week. As you look at the chart, we're kind of in a bit of a trading range. On the low end, we've been in that 360 has been kind of holding. It's going to be interesting to see the next couple of days whether we see a bounce back above that 360, suggesting that maybe that floor remains kind of in place. And on the upper end, it's going to be hard to break out above that 380, 385 range. And I think as you think about it, if you have some old crop inventories remaining that you're thinking about pricing or wondering about pricing, our advice would be in the short run, hold off a bit and see what happens. Historically, we tend to get a pretty strong tendency to get a spring planting rally, usually based on some weather conditions. That could easily be the case this year. And so our advice would be to hold off on old crop sales at the moment and see if that spring planting rally does in fact materialize, Michael, and maybe take advantage of it. And if it does materialize, I'd probably be pretty aggressive about moving those old crop inventories.
Is there a danger of holding on too long?
There is a danger of holding on too long. If you look at it from a historical perspective, we've been doing some work with Nathan Thompson in our department, as well as one of his graduate students, Aaron Edwards, looking at those returns over time. And you probably don't want to hang on much past that spring planting period. In fact, I think in that data set that we looked at over the last 30 years, probably somewhat risky to hold past roughly the 1st of June. So it really is kind of the idea of looking at for a spring planting season kind of a rally here over these next 2 months. So I'd watch that pretty carefully. If you look at new crop, the new crop picture was really looking a little better than what we were seeing on the old crop. But again, a pretty strong reaction to the acreage report on Friday and to some extent the corn stocks number. And as you look at it, again, I think if we see a weather rally this spring, that might create the opportunity to see that contract get back up in that 395 or maybe a little stronger range. And if we do, again, that's probably a selling opportunity to do some pricing on the new crop. In the short run, we'd be inclined to hold off and see how things shake out here over the next few days and see if that spring planting rally actually materializes.
I do think it's important to point out that at this point, if you look at kind of a possible price distribution of where prices might be heading this fall, a price above $4, certainly a cash price above $4, has a relatively small chance of happening next fall.
Indeed. And I guess the other thing I'd point out is we didn't put any slides on this, but as you look at storage returns, evaluate the opportunities to lock in carry in the futures market. And I keep having trouble with the slides here. Why is that? So I would evaluate those storage opportunities and the opportunity to lock in carry and the opportunity to lock in potential basis appreciation as you move through that storage season. And we've been looking at that when we've done some workshops here over the course of the winter. There have been some attractive opportunities.
And the reason I mentioned the $4 is we're going to be showing some break-even prices later. The break-even price using full costing, cash and opportunity cost, right now is right about $4.05, $4.10. And so if you're holding out to get a price above that break-even, that might not be such a good idea.
Let's take a look at the soybean chart. The picture looks a little bit different. We've been in kind of a sideways pattern with a fairly wide range on the May 19 soybean futures. Prices didn't react quite as negatively on the soybean side on Friday as they did on the corn side, and that makes sense with the reduction in soybean acreage. But as you look at it, again, holding off a little bit, perhaps waiting and seeing if we see some improvement with respect to a planting time rally or possibly some positive news on the trade side. Either one of those could provide a boost on the short run with respect to May futures. You look at new crop futures have been kind of tailing off here really for the last roughly 2 months. We've got that top in there in that ballpark of about 960 or so. The bottom looks like it's maybe in the ballpark of $9. And so as you see opportunities towards the upper end of that trading range, maybe locking in some returns there would be a good move on the crop.
And even though the acreage was down from the pre-report estimate and down down from last year considerably, there's still quite a bit of downside risk in the soybean market, and so I think that's important to keep in mind.
Yeah, and from that standpoint, a lot of people at this point haven't done very much pricing, perhaps a little bit here earlier in the winter. I would suggest looking pretty hard and keeping pretty close eye on these prices on a week-to-week basis over the next 2 months, and look for some opportunities to lock in some of those spring pricing opportunities, which have a pretty strong tendency to occur. They don't occur every year, but given some of the weather problems and some of the issues taking place in the Midwest this year, this might be a year for a decent spring planting rally. All right, let's take a look at estimated margins. Michael, you've looked at this pretty closely.
Yeah, let's look at corn and soybean margins and compare that to overhead costs. Overhead costs, in terms of this graph, include land costs, labor costs, and machinery costs. And so keep that in mind as we're going through this chart. Not surprisingly, contribution margin increases as the productivity of land increases. But guess what? So does the cost, which we'll show here in a little bit. Let's compare that to soybeans. And this may be a surprise to some people, but soybeans are still very competitive. And this was using Thursday's prices, not the Friday prices when we saw the drop in corn prices. And so using Thursday's prices, soybeans were very competitive, even on the high productivity soil, clearly showing that the contribution margin for soybeans was higher on each of these soil types compared to corn. And here we're comparing rotation corn and rotation soybeans. It should be obvious that if you're comparing rotation soybeans to continuous corn, there'd be even a wider difference, meaning that rotation soybeans would be considerably more profitable than continuous corn.
And that's a good point, Michael. I think the other thing to think about is if the price shift that we saw on Friday holds, it's going to make soybeans look even more attractive.
Yes.
Particularly here in the Eastern Corn Belt.
Yeah, in the Eastern Corn Belt, we may revise some of those acreage, increase our acreages of soybeans a little bit if those prices hold.
Yeah, and I think that's a key point to think about. This is the planting intentions report. We're probably going to see at least some shifting taking place between now and planting time, and part of that be driven by weather, but the other one could be driven by some of the closer look at some of these margins. Right? All right, let's take a look at those overhead costs. This is the part that doesn't look so pretty,
yes,
right?
And so let's focus on the far right of the high productivity soil. If we look at land, labor, and machinery costs, they're $387 per acre. About $265 of that is land costs, and so cash rent is pretty high on the high productivity soil using our budgets. But we're certainly not looking at a situation where we're covering all costs. Now, keep in mind here that we are looking at full costing, so we have cash and opportunity costs included. If you took out some of these opportunity costs, we would be including cash. We obviously would be covering cash costs. We're just getting a very low return on land that we own, machinery that we own, and some of our labor.
Yeah, good point.
If we look at break-even prices using that same information on the previous chart, total cost per bushel for rotation corn is right at $4.10. The main cost that's higher this year compared to last year, the last 2 years, is fertilizer cost. Fertilizer cost is up about 10%, looking at nitrogen, phosphorus, and potash, and that has increased the break-even price compared to what it would have been a year ago for rotation corn. For rotation soybeans, we're right at $9.90, and so both of these break-evens are obviously higher than the prices we were talking about earlier. Now, again, if you took out some of the opportunity costs, the break-evens would be considerably lower than this. For example, if you took out some of the opportunity costs for the case farm we're going to be talking about here in the next few slides, the break-even price would be closer to $3.50. But it's always dangerous to take out those opportunity costs because in the long run, we need $4.10 to cover all of these costs. We can make it in the short run with something less than that, but in the long run, we need something closer to $4.10. And so if these costs would persist, another way of saying that, if these costs would persist, we would expect one of two things to happen. Either the costs have to come down to meet the long-run prices, or the prices have to come up to meet the cost of production. And so we're kind of looking at waiting a game, which of those is going to happen.
Yeah, and I guess if you project out, and think about what's most likely, historically what would take place over there would be a driving down returns to land, and land values, right? That's the big the factor that's got the most inelastic supply, so that's normally the one that would get the biggest reaction. The other thing I was thinking about, Michael, is we've been using these budgets off and on all winter, as you and I have been doing presentations around the state of Indiana and elsewhere. Those costs have gone up over the course of the winter. Earlier in this winter, I think we had break-evens on corn on this exact same budget, roughly $4 or maybe
closer to $4.
And on the soybean side,
probably
it was down
$9.70.
Yeah, $9.75, yeah. So it's gone up, and it's largely based, as you pointed out, on the fertilizer side, which is largely being driven by what's taking place in the oil markets, right?
If we look at historical and projected earnings per acre, well, let's compare 2018 to 2019 and 2020. This chart looks at the historical returns back to 2007. As we've talked about many times before in these webinars, 2007 to 2013, you pretty much were able to cover all cash and opportunity costs, except for corn in 2013 with a slight loss, but certainly a different situation since 2014. 2018 actually was a very good year for soybeans. A couple things going on with soybeans in 2018. The yields were very strong in Indiana and across the Corn Belt for that matter, and also the market facilitation programs really helped increase the earnings per acre for soybeans. And so the earnings per acre for soybeans were considerably better for corn, but even corn, if you look at 2018, it was relatively strong compared to what we've seen 2014 to 2018. And so putting those together, 2018 didn't turn out to be that bad of a year. Certainly much better than what it looked like last July. And so higher soybean and corn yields were very helpful, and then those market facilitation program payments for soybeans. Looking at 19 and 20, if you assume that we're going to have limited government payments, we might have some government payments from the 2018 Farm Bill in 19-20, but they're probably going to be relatively small. And also, if you look at trend yields, we're looking at some pretty tough earnings per acre for both corn and soybeans in 19 and 20.
Michael, let's back up just a little bit for viewers that maybe aren't familiar with the case farm that you're basing this slide on. Could you give us a little description of that case farm?
Yes, I should have done that. This case farm has 3,000 acres and uses a corn-soybean rotation.
And it's based on, truthfully, some data that you've pulled together over the years coming out of White County, Indiana.
Yes.
So it's representative of productivity in White County.
It's representative of productivity in that area. We use costs from our budgets to try to come up with a cost of production. And this would be considered high productivity soil, so we're more in that high productivity soil part of the budget.
So it's pretty realistic, and you've gone back and simulated the returns going back really over the last, what, 10 or 15 years?
Yeah, okay. Longer than that, actually.
Yeah, so you can kind of track how this farm is performed financially, and that'll set the stage because we've got another slide coming up here, right? All right, so.
I always like to use this chart in meetings because it takes a very close look at corn versus soybeans, because obviously these corn and soybeans compete for acreage, and our situation is quite different today compared to what it was from 2007 to 2012. In 2007 to 2012, we had a couple different things going on, but one of the main things that was going on there is we were increasing corn production to increase ethanol production, and so there was a very high demand for corn, and so corn was more profitable compared to soybeans. Since 2013, it's been the opposite. We've had continual strong demand for soybeans, particularly from China, importing soybeans from the U.S., and so that's actually made soybeans more profitable than corn, and that's been the case since 2013 all the way through 2018. Now, you might be looking at that 2018 bar and say, what is going on there? Why was soybeans so much more profitable in 2018 compared to corn? Well, at least half of that was the market facilitation program payment. The other half was we still had fairly decent soybean prices compared to corn in 2018, particularly early 2018, and then also we had relatively high yields for both corn and soybeans, but particularly for soybeans in this part of Indiana, and so that made soybeans very profitable in 2018. Moving into 2019, 2020, corn is certainly more competitive. This again was using prices before the drop on Friday. This is using Thursday's prices. Corn is more competitive, but notice here that soybeans still have slightly higher profit according to this chart, according to our number crunching going into this chart in 2019 and 2020.
And so again, the price change on Friday would actually
make soybeans more attractive relative to corn.
So as you're thinking about any possible changes in your operation, look pretty closely at those budgeted yields and productivity and profitability on your own farm, and look at where you're at with respect to what those acreage changes might mean to you.
And I also should say, this is comparing rotation corn and rotation soybeans. Continuous corn would not look as good as these charts suggest. And so if you're looking at continuous corn rather than rotation soybeans, soybeans would even be more attractive.
And that's a good point, because in Indiana, on the flip side, we've had some people do continuous soybeans, at least on 2 years in a row.
There's been quite a bit of second-year soybeans the last 2 years.
And if you look at the bars on the right-hand side, all of a sudden that program doesn't look quite as attractive either.
Yeah, but it's certainly not switching back to a situation that we had from 2007 to 2012, where we saw quite a bit of continuous corn in Indiana.
No, but it might favor people switching out of a multi-year soybean planting back into more of a 50-50.
Definitely. And if you look at the acreage, the acreage report, we're much closer to 50-50 in 2019, the prospective plantings, compared to last year.
All right, coming back to your case farm again. You've looked at profitability from really the last dozen years or so, right?
Yes, and first of all, we look at the 10-year average here. We look at an operating profit margin ratio of about 17.5%. Very healthy operating profit margin ratio. This would be above the average that you'd see for farms across the U.S. over this time period. So this farm is above average profitability, if you will. So I do want to point that out. But certainly, 2014 to 2019 are much different than 2007 to 2013. But I think it's very important to point out is the profit margins we saw in 2007, for example, 2008, 2010, 2011, 2012 are really aberrations. It's very rare that you would see profit margins of 25 to 30%, even for a farm like this that has above average profitability. And so to expect us to return to that anytime soon is unrealistic in my book. But certainly looking at 2018, we had a profit margin of 11–12%. That's not too much lower than the kind of the long-run average if we would include the early 2000s in this particular chart. And so it just shows you again that 2018 turned out to be not too bad a year. If you look at 2018 to 2019, 2019 on this chart is assuming trend yields, and yields were considerably higher in 2018 in this part of Indiana, 10 to 15% higher than trend in west central Indiana. And so if we take that out, and then we account for the fact that we're not going to get those market facilitation program payments, and that profit margin is much closer to zero. Another way to think about a zero profit margin is to back up here a little bit and talk about how do we calculate the operating profit margin. We essentially take net farm income, add interest, and then subtract family labor from that, and then we divide that numerator by gross farm income. And so one of the key sets of numbers to look at is net farm income versus unpaid labor or family labor. And what that 2019 bar is suggesting is we're going to have trouble covering family living expenses on this farm in 2019.
Yeah, and so just to reiterate, as you think about projections for 19, the drivers behind 19 being so much worse than 18 is an expectation at this point in the year that we would see a return to trend yields.
Yes.
And when we say trend yields, what we're really talking about on most farms is using the yields coming off your crop insurance, right, which is based on a 10-year average. So it's adjusted for a trend over time. And then the other driver there is the fact that there's at least no expectation right now that we would either necessarily resolve the trade situation with China, which would give us a boost in prices, or see another round of market facilitation program payments.
And if you look at the PLC prices, the prices for corn and soybeans, the PLC price for corn is $3.70, and the PLC price for soybeans is $8.40. The prices we were talking about earlier could be under that, but not by a lot. And so if we get payments, they're going to be relatively small compared to the market facilitation program payments, and that's the point we want to make.
Yeah, and if we're going to trigger one, it'd be more likely to trigger it in corn, it would appear.
Yes, definitely in corn.
All right, let's kind of wrap up here, I think. So our current projections, as we just illustrated on the last slide, for corn and soybean returns in the Corn Belt in general and here in Indiana in particular look pretty weak, particularly as you compare it to last year and maybe historical averages. And that's based on that return to normal yields or trend adjusted yields really. Little higher cost on the fertilizer side. We've got large carryovers projected for corn and soybeans, and no expectation at this point for another round of trade assistance payments, and that's based on the announcements that Purdue or USDA made last fall. And then if there are some payments that arise from the 2018 Farm Bill, it's a little early to project those with very much accuracy, but if there are some payments, we think they'd probably be relatively small, and certainly not anywhere close to the magnitude of what the MFP payments were in 2018. So that's the reason behind our projections for a pretty negative margin situation, pretty tight margin situation in 2019. From a marketing strategy perspective, we think you should pay very close attention to the possibility of some spring planting rallies here over the next roughly 2 months or so, maybe a little longer, but certainly on corn between now and Memorial Day. Soybeans, historically, that period might extend a little bit farther. The other thing to be very cautious about and be a little bit concerned about is as we carry inventories forward with the kind of carryovers we're projecting, there's probably going to wind up being some crops carried over from obviously this marketing year into the next marketing year, and that's going to put a larger amount than normal. And that could put some significant pressure on basis here throughout the Corn Belt this summer. And so as you think about storing past, for example, Memorial Day or maybe the early part of June, you're putting yourself at some risk of some basis weakness, and that could be kind of a challenge. So be wary of that, be thinking about that as you make your marketing plans here over the next month or two with respect to old crop. And on the new crop side, obviously also take advantage of those spring planting rallies if they materialize. And they don't necessarily materialize every year, but historically there's been a pretty good probability of that taking place. We would be watching those pretty cautiously, pretty aggressively actually, and looking for some opportunities to do some pricing. So with that kind of wraps up our discussion this morning. Our next Crop Outlook webinar is scheduled for early July, July 2nd, and that'll take place following the USDA's acreage report, which comes out at the last Friday of June. So there'll be more information on that on our website, and you can register there at purdue.ag/webinar. Thanks again for joining us. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and on behalf of the Center and Purdue Extension, thanks for joining us.